The way I like to think of the Fed is before you start out thinking about the Fed, you have to think of Econ 101. And in Econ 101, they have this wonderful narrative. And the narrative goes something like, if we raise or we lower interest rates, something happens to the economy. Either it goes faster or it goes slower. And as a result, inflation either goes up or down. This is a wonderful narrative. Now let's get to the real world. Fed raises rates, nothing happens. How come? Well, the economists say that's because monetary policy works with long and variable lags. As best as they can figure out, those lags are 18 months. Now let's consider for a second the U.S. economy, if we could. Do you really think it's monetary policy that's influencing the U.S. economy 18 months from now? Or do you think there's a lot of other things that could be influencing the direction of the economy? And that the economists are simply declaring victory if the economy ever moves or inflation ever moves in their direction. I'd tell you, it's declaring victory.
Right.
Okay. And think how many people are employed in the mainstream media and on Wall Street saying, oh, Fed has to be independent. Fed monetary policy matters. No, it doesn't.
Right.
I mean, it doesn't take effect for 18 months. We can pretty much rest assured didn't really produce any result. So now let's go back to what the Trump administration has been saying so far. They would like to have a voice in setting monetary policy. And I wholly think they should. In fact, monetary policy should be 100% in the Treasury.
Right.
After all, fiscal and monetary policy are two sides of the same coin. If we're a deficit issuing country, we issue debt and we pay an interest rate. Why should we have some say in the interest rate that we're paying?
Right.
Okay. There is no reason whatsoever.
I think your point about the Fed declaring victory is a very powerful point from my perspective. So I'm a stock caller, right? And I do trades. Now, whenever I have a trade that is correct, I have to confess, I'm just as surprised as everybody else, right? I'm taking the best information at the time and making a decision, right? And one of the things that I find in trades is that often people who are trying to ascribe a narrative to anything the market is doing are most likely wrong. Because as you say, the U.S. economy is a summation of trillions of individual decisions, and the effect of tiny interest rate changes on such a vast and prodigious economic entity are likely very negligible, right? It's almost quite rational when you think about it.
If you look at the world from a corporation's point of view, there's this argument that economists like to put out that says, as rates go down, companies should be doing additional projects that have what they call net positive value,
right.
Net present value. Okay. Well, it turns out you have to figure out how you're going to discount your cash flows from any investment. That's okay, because the first thing you had to do was figure out what the cash flows might be. And I can assure you, when there is no demand for your product, there is no such thing as a net present value that's positive from an investment. Okay.
Right.
The next thing I can guarantee you is, even if you can figure out what you think the cash flows are going to be because there's demand, well, there's a cushion built into every spreadsheet in the history of mankind because they realize they're unlikely to predict the future perfectly. Right. So everybody wants to kind of be able to do a CYA maneuver.
You know, you point out, as an equity analyst, you point out something that is very true of all discounted cash flow models on the equity side too, which is 70 to 80% of them are terminal value, which is an earnings rate far in the future that is literally impossible to predict, of course.
Correct. All of this is impossible to predict. See, back in my youth, I used to talk about trading a lot. And what I used to say to people, when you're going to make a trade, the first thing you have to do is look at the security you're thinking of trading. And you have to decide, is it valued correctly? Maybe it's overvalued. Maybe it's undervalued. I don't care which direction. You have to have a good idea as to why the market's not valuing it correctly. That's number one. Number two, you need to have a driver. What's going to drive the valuation to come to what you think the valuation should be? Whether that's the stock going up or the stock going down. So the question is, what's the driver? Many investments are made when people go, oh, the stock's undervalued. They have no idea what's going to ever drive it to be properly valued. They hop in.
Nice.
Much of the narratives we hear are, oh, the stock went up today. Not what caused the stock to go up in a particular example, but rather just it kind of went up. Okay.
Right.
That said, I look at something like Bitcoin. When Bitcoin first came out, it was we're separating you from the government so you have no governmental risk. Now, the Bitcoin promoters are celebrating the idea that they may soon have a strategic Bitcoin reserve. What does this tell you about this artificial internet coin? It has no intrinsic value.
The narrative keeps changing to fit the price movement.
Correct. Oh, absolutely. And it's perfectly flexible, this narrative. Okay, let's go back to getting the Fed a second. If you take away monetary policy and you move it back to the Treasury, I have to deal with the priesthood of the economic PhDs who will all scream at the top of their lungs, but then prices will be set, the interest rate will be set, and it will be a political interest rate. The Fed has never been politically independent. I was there when Paul Volcker was raising the rates, and we got prime in the lower 20% range. Of course he was doing that with the blessing of the White House and Congress. He didn't do that just arbitrarily.
Right.
Okay. We need to get over it. It has always been political. Alan Greenspan even said so, that he was political, that he bowed to his political masters, whatever they wanted, that's what he delivered. Right. And heck, he was only the chairman of the Fed for 2 decades? Okay. It just is a political entity. If you move interest rates back, though, to Treasury, I would argue that interest rates aren't going to be changed. And the reason is fiscal policy has an immediate impact on the economy.
Right.
Monetary policy has a lagged, uncertain impact. So if you were a politician, what would you rather have? Something that immediately does something to the economy, or something that may or may not do something at some far out point in time that could be passed when you're up for re-election again.
Right.
Okay. I think that they're just simply, if they moved the monetary policy today to the Treasury, you would see that Treasury would never change rates. They're at a long run historic average. The economy has done just fine when we've been at this rate for long periods of time.
Right.
We should leave it alone and never touch it again.
I have a question for you about the Fed and moral hazard. Do you see one of the main advantages of moving the Fed under Treasury to stop the buildup of moral hazard in the economy as well? Because through the independent functions and a lot of the emergency powers they've given, they've become a de facto policymaker, really. They've made some of the most profound economic policies of our time. And do you see that as a perpetual problem in terms of creating opacity in the banking system?
Let me just say, leading up to the financial crisis of 2007, which is when it started,
Right.
most people think of the acute phase that hit us in the fall of 2008. That financial crisis was an earthquake along the opacity fault line of the global financial system. All the opaque securities overnight were recognized as not being able to be valued. And investors wanted to get their money out. Included in those opaque securities was everything issued by the commercial banks. That was unsecured debt in the banks, equity in the banks, etc. It was seen that there was no way to value these banks because nobody knew what was on or off their balance sheet that they were exposed to. Fast forward from 2008 to 2024, these banks are bigger, their balance sheet is more opaque, so the problem hasn't gone away. The moral hazard, though, had gone up exponentially because now we have the Fed having taken the position that says, even if these institutions are insolvent, we will stand behind them. Huge big deal. Okay. Now, I want to be clear about one thing. I'm only talking about moving monetary policy, which is one of the Fed's functions, to Treasury.
So it would stay as one of the more important prudential regulators for the large banks, correct?
Nope.
Oh, okay.
They've shown they can't do that. Okay?
The revolving door is certainly a problem.
Like, it's a problem. And Bernanke testified before the Financial Crisis Inquiry Commission that I think it was 12 of the 15, or maybe it was 13 of the 15 largest banks were going under. Had we not had we chose to lie about their solvency.
Right.
Okay. Well, that pretty much tells you that they weren't a very good regulator.
Of course.
Okay. So now, the logical entity to get bank regulation is the FDIC. And I think it should get 100% of bank regulation. So things like the OCC should also be giving up any role in bank regulation.
So would that mean getting rid of the national charter as well?
They could charter banks. I'm happy to let them charter banks. What the OCC can't do is they can't supervise and regulate them.
History would support your assertion.
Correct. I'm saying all supervision and regulation should be concentrated in the FDIC. And the reason for that is the FDIC is the only financial regulator that can close a bank. The Fed can't close a bank.
Correct.
If it says B of A is insolvent today, time to close it down, it can't step forward and do it. It could turn to the FDIC and say, do it, but the Fed can't do it itself. But when you put everything into the FDIC's hands, now you reinforce market discipline. Because if you know there's a regulator there who is looking at that bank and may step in if it's taking too much risk or it's becoming too close to insolvent,
right?
You as an investor have an incentive to apply market discipline to that bank and its management to get it to reduce its risk-taking.
One of the things I love about using transparency is the cornerstone in regulation, which is your theory that you're known for, is a lot of people think it's tougher regulation and it should automatically be an idea sort of categorized in one way. But in my estimation, and this is with, real experience supervising examiners and stuff like that, you're number one, you're going to save a lot of money in labor if you let the market do the regulation with transparency, right? And you're going to have a more effective regulation, of course. Not only that, rather than the banks playing games, and like one infamous example from my past that brings up your theory was when I was working on the Basel supplementary leverage ratio rule as a young man, pouring through those thousands of pages. One of the things that was amazing was that so many banks used derivatives that actually increased economic risk to reduce regulatory capital ratios. I mean, it was an alarming practice, and that's part of why the derivatives losses were so cataclysmic, of course, until they were resold to BlackRock and PIMCO, right?
Or swept under the rug is the way I like to say it.
Right.
If you look at this, though, why would we think that a couple hundred bank examiners, even a couple thousand bank examiners, would be as good at examining the risk of Bank of America as JP Morgan would be?
Right.
Okay? They're in the business. They know the borrowers. Theoretically, they have systems for identifying risk. So they could sit there, they would come up with a better solution. And oh, by the way, JP Morgan has it, Citi can do it, B of A can analyze Citi. And if you said to me, gee, all that data, these big banks couldn't handle the B of A's massive amounts of data, well, that's just an argument for breaking up B of A.
Right.
Okay?
Absolutely.
You get it down to a size where they can analyze it. And by the way, I'm not taking the regulators out of the business of analyzing the banks. I think they should.
Right.
But no reason not to ask the market participants what they think. After all, I like to tell people we live in a wonderful period of time. It's called the information age. ChatGPT couldn't be trained to go through all of B of A or all of JP Morgan and figure out the risks there.
I think it could. And one thing I was going to bring up to your point here is that Dodd-Frank, it had some very well-intentioned things like the Dodd-Frank Act stress test. But I think the way the Fed behaved with it really proves the regulatory capture element. It's the Dodd-Frank Act stress test started in all the best intention. It's really become a cheerleading session for the banks. And it has very little value for the market as it was intended to. And it's because the process is opaque, and it's because most people don't assign a lot of credibility to it.
Well, let me go to say, A, you're right. And B, the credibility that the tests have is it's the annual moral hazard where the Federal Reserve guarantees that the U.S. government will step up for all these insolvent banks and make sure you don't lose any money based on their being insolvent.
Right.
So you go back to your moral hazard. It's the biggest moral hazard in the entire financial world are the annual stress tests. You also have to ask yourself a question. I go back to FDR because it's kind of fun.
Yeah, it is always.
And FDR said, federal government should never recommend an investment. It should make sure that the information that is necessary for an investor to make a fully informed decision is made available to the investor. Right. Now, let's go back to the stress test a second. Why is it that the Fed is the one running the stress tests and not the market?
Right.
Okay? The market would run the stress tests all the time on these banks. If you consider the difference between what should be, if you had the world of transparency, and what we get, okay? Dodd-Frank was a wonderful example of trying to substitute regulation for market discipline. And it was regulation that the banks chose so that they knew they would never be subjected to any discipline and they could take as much risk as they want. There is nothing good in Dodd-Frank. If the whole act was repealed tomorrow, the U.S. would be better off.
I have one question that's a real inside baseball question for Dodd-Frank, just since we got into it and just since I've spent many hours in the bowels of the thousands of pages of it. So one of the, well, not good for me, unfortunately. It was fine, but you make of it what you will. But so one of the most important and crucial regulatory reforms of Dodd-Frank was putting everything onto centralized clearinghouses, right? Now, to me, the bilateral transactions obviously had their problematic aspects, like, of course, between AIG and Goldman. But when you really look at what happened there, it's because Goldman had better lawyers, but when they were discussing valuation in court, but B, the counterparties, while they weren't able to assess risk properly, partially because of the breakdown of the ratings agencies, in my mind, the bilateral transactions actually have more transparency because there is no way that these central clearinghouses can truly understand the risks that they've shouldered. I mean, you have $600 trillion of notional derivatives risk. And I just wanted to point out, I don't think there's any transparency there. And I think that could potentially be a failing point of the financial system.
Absolutely. I mean, the problem that these clearinghouses all have is both parties to the transaction are opaque to the clearinghouse.
Right.
So the clearinghouse has no idea how much margin it should be holding against these transactions for one party or the other or both going under.
A Norwegian oil trader broke the S&P waterfall a couple years back. One oil, because of exactly what you say. And I think that frankly is one of the bigger black swan risks created by Dodd-Frank, that a lot of people, they just don't understand it, so they ignore it.
There's so many black swan risks in Dodd-Frank. The leading one is that Dodd-Frank did anything positive for the financial system. It didn't.
Let's talk about, now we have a real possibility of a lot of Dodd-Frank being rolled back, a lot of Basel III being rolled back. And I think that's definitely on the agenda for the Trump administration. And what do you see? How do you see that affecting the financial system, lending, and risk taking?
Well, let's imagine for a second that we could put and all of Dodd-Frank would go away.
Okay.
As long as the banks remain opaque, they'd be perfectly happy taking excessive amounts of risks where heads the bankers win, tails the taxpayers lose.
Right.
Okay. Dodd-Frank hasn't changed that at all. Okay. Every bank I know always makes a loan that it thinks is a good loan. That's the nature of a bank. You look to see whether the borrower can repay their loan. That's the analysis that you do. If you conclude that the borrower can do so, you make the loan. They're not going to take on riskier loans because they already are taking on a certain level of risk, and they're not going to take on more risky loans. There are borrower lenders in the market, call it private credit, who are happy to lend against these riskier borrowers. I call that a transfer of the creditor's money to the private equity funds. Okay. That is all that is going on there, because it's an opaque black box where excessive amounts of risk are being taken and not being properly compensated for. Okay, but
Right.
I see this going on in the market. If I can go back, one of the things we don't talk about is the SEC, which is ironic because the SEC was given the role, the responsibility of making sure there was transparency. Back in 1981, we had a very popular president by the name of Ronald Reagan. And Ronald Reagan insisted that the SEC needed to stop making investors its client and rather Wall Street, because Wall Street was the one that was effectively paying the bills for the SEC.
Right.
Well, it's an interesting thing when you make Wall Street the client, because issuers prefer opacity. They want the buyer to misprice their security.
Well, of course.
That way they can sell it at a higher price.
Sure.
If you are Wall Street, you also prefer opacity because you get to build a bigger margin. So you make more when you sell a security. And Wall Street is really good at selling securities and spinning stories. That's its specialty.
Absolutely.
I used, a number of years ago, I developed something called the information matrix. I don't know if you have seen it. It's a 2x2 matrix. On one side is a buyer, on the other side is the seller. And the question is, does the buyer have enough information to know what they're doing or not? It's a yes, no. Does the seller have enough information? Yes, no. When both buyer and seller both have the information they need for a fully informed decision, we call that perfect information. All of finance is based on perfect information existing. Okay? Every finance theory you will see assumes perfect information.
The efficient market hypothesis.
Correct. The efficient market hypothesis, but actually, the efficient market hypothesis has three forms. I'll talk about each of them, but before we go there,
Long form of
I want to focus on the four quadrants so the listeners understand what the four quadrants are. There are two quadrants that are diagonally opposite each other. One is the seller has information that the buyer does not have. And if the buyer had the information, the buyer would act differently. George Akerlof, Janet Yellen's husband, got a Nobel Prize for this.
I love that essay. It's one of my favorite. I think it's one of the most timeless economic essays there is, frankly.
Okay. It's a fantastic essay. The opposite of the lemon problem, where the seller has the information, is the antiquity dealer problem. The antiquity dealer problem is introduced by Joseph Stiglitz, which is why he, at the same time that Eckloff won the Nobel Prize, he too wins it. In the antiquity dealer's problem, the antique dealer walks up to your house, you're having a yard sale, and you've got this old vase, and you have no idea what it's really worth, but you put $50 on it. He walks up and says, oh, that's a Ming vase worth $50,000. I'll buy. Okay.
Right.
And you can kind of see the fact that he wants to buy it so easily. And he's, but he can't keep the grin off his face. Tells you you've mispriced it.
Right.
You kind of go, no, I'm not selling it for 50 anymore. But that's the antiquities. Both of those are known in the trade as information asymmetry. One party has the information, the other party does not.
And this makes for inefficient markets.
Yeah, absolutely it does. There's one more quadrant, though, that God love the priesthood of the economic PhDs they don't look at. And that fourth quadrant is the most important quadrant of the four quadrants. And that's the imperfect information quadrant. That's where neither the buyer or the seller has the information they need to make an informed decision. Effectively, they're both blindly betting. I love to hear from the priesthood of the economic PhDs how that doesn't exist. Okay, nobody just blindly bets. Well, let me give you examples of securities that people have blindly bet on. Let's say the stock of JP Morgan. Nobody knows what's that $2.5 trillion of exposures they have.
Having been on bank examinations, I can confirm that is 100% true.
And by the way, that's also bank examiners.
Right. And also the risk is never normally distributed. The sampling techniques are basically worthless.
I'm not going to argue with any of that. You are absolutely correct. So, but people buy and sell JP Morgan stock all the time.
You can see this in the valuation of all bank stocks. You have to value them completely differently than most stocks that have more transparent business lines, right? And they're trading, you have to value them at book value. And of course, their PE ratio compared to stocks with more transparent forms of earnings and assets is much lower.
But by the way, I don't have to value them. See, when you're somebody like myself, you go, oh, wait, this is an opaque security.
Right. I'm not going to buy it.
My portfolio, do I want to put into gambling on opacity?
This is a very useful conversation for our subscribers. I'm glad you brought it up.
Okay. I'm not saying that you can't make money buying opaque securities. The history of Wall Street is they're very good at rolling out an opaque security that for the first few years does well.
Right.
Then when everybody piles in, it's like a rug pull.
Right.
They lose their money. Well,
that's the whole purpose of investment banking.
There you go.
Yes.
So all I can tell you is not that you have to necessarily always avoid an opaque security, but you got to ask how much exposure do you want to have? That's sort of the blind gamble. And do you think that the upside from the gamble is going to reward you enough for having put the capital at risk? Okay? Because it's a high risk investment.
Right.
Okay? Having said that, all structured finance falls in that category, and the private equity things, private credit, the private equity partnerships, all of that. We've got trillions of dollars of opaque securities in our system today. And by the way, opacity is the necessary condition for a financial crisis. Let's go back to 2008 where I said it was an earthquake. When you have an earthquake come along the opacity fault line, everybody suddenly goes, wait, how do I value that security? What's it worth? Ooh, there's no information. Let me run and go get my money out. Okay? We are far more prone to a financial crisis today than we were in 2008.
Right.
Now, back to the SEC. The SEC is singularly responsible for this failure And that's because the SEC has never adjusted the concept of what qualifies as an accredited investor. Back in the 1930s, there was this idea that Mellon was a really smart guy. And Mellon could hire a bunch of really smart people. And if somebody needed Mellon's money, they would disclose to Mellon all the information he needed. So there was no reason to protect Mellon. And that seems like a pretty good idea. However, there were only a handful of people who qualified back in the 1930s for this accredited investor. Now let's fast forward where we've had 40 years of markets growing by leaps and bounds. The number of accredited investors is huge. And Wall Street is very good at taking advantage of the bigger pool. They don't need all the accredited investors to buy any investment. They shop around to find the bigger pool who will buy whatever they're selling, whatever toxic security it might be. Back to the SEC, it needs to move up the definition of accredited. In today's world, if you don't have $1 trillion that you're directly managing, you shouldn't be an accredited investor. And by the way, $1 trillion is at the fund level.
Right.
So if you're BlackRock and you've got 11 trillion you're managing, unless $1 trillion of it is in a fund, that every other fund isn't accredited. Okay?
Right.
You can't roll this out to retail because you can't offer them, again, that they're accredited.
Right.
So this whole thing needs to be undone. And by the way, if they just would do that, you'd be amazed how fast opacity would go away and transparency would return to the markets.
Honestly, sir, that makes a lot of sense to me. That's quite an idea.
By the way, easily implemented if you are the Trump administration.
I have one parting question that everybody wants to know, and I want to get your take on what mechanisms or strategies do you feel that the Trump administration will use to go after Fed independence? Now, do you think they will go and change the Federal Reserve Act after this wave, or do you think, as some have suggested, they may appoint a shadow commissioner to undermine the role of the chairman and try to bully pulpit him out?
Well, Trump already got in his first term the interest rate policies that he wanted, the monetary policies that he wanted. Okay. And traditionally, it's always been bad theater.
Right.
The politics, okay? The politicians like to say, oh, we didn't have any influence on these bad policies, even though we gave hundreds of speeches saying we want these policies. Right. It was these technocrats who pursued the bad policies. Well,
right.
That's not true. Technocrats said, you tell us what you want and we'll give it to you. Okay, so that's just bad theater where they're trying not to be responsible. Trump has come out and said, I want to be responsible. Now's the time to redo the Fed. In 2009, 2010, when Dodd-Frank was being debated, there were very few voices saying, why are we not stripping the Fed of all of the functions it showed itself not to be fit for purpose for? At the top of the list were bank supervision and regulation and monetary policy. Let's take them both away. And oh, by the way, the Fed doesn't need either one of them if you force the banks to be transparent for the Fed to act as a lender of last resort. The Fed can easily do that.
Right. So that makes a lot of sense, to just keep it as the lender of last resort. And that's its primary function.
Well, it's got a second function that's really very important that it retains. And that is the Fed is actually in charge of the payment system.
Right. PACH.
Right. So right now our problem is that we use like JP Morgan to have your checking account at. I think that Donald Trump should introduce the concept of a checking account at the Fed. And you don't have to keep your money at the Fed's checking account or the savings account, but that's where your employer deposits the money. You can then roll it wherever you want to roll it. You can buy Bitcoin with it for all I care, The point is, when you do that, and the corporations have their accounts there, suddenly you've done away with all sorts of problems, like the private banks holding our payment system hostage when they blow up.
I would like to point out that you can instantly transfer money in Somalia, but in the United States, that's still a heavy chore through the banking system.
Right. This would change the lift dramatically. And I would think that the GOP would be very good at writing the regulation for this central bank account so that government can't pierce the accounts willy-nilly to see what you're doing. So they grant you anonymity. A lot of people are worried that, if the Fed can see what you're going to do, they're going to try to influence it. But by taking monetary policy away from the Fed, they can't take down, the interest rate paid. And by the way, I think they should pay interest on those accounts, 2-3%.
Right. Yeah. I mean, that would be great.
There's no reason that the Fed shouldn't.
Right.
Okay. At this point, we solved a lot of the problems in the financial system. The solutions actually are really easy. But now let me come back to something. There is no way in heck Wall Street will let them come to pass. And they have spent a lot of money buying a Congress they can control. And I think a president who they can control.
I do unfortunately think you're correct there, Dr. Field. But nonetheless...
So please, you don't have to call me doctor.
Well, nonetheless, though, I think a discussion of these ideas at this point is particularly useful for the reasons that there could be some of the most radical change we've seen. And even getting your ideas out there is helpful, and that's part of why we wanted to have you. I also wanted to point out, you've referred to the priesthood of economics a few times. We at Punk Rock Traders, we're called Punk Rock Traders. I was in a punk rock band when I was a kid, but also because we embrace contrarianism. And so we wanted to single you out for having a very contrarian bent to you, and you've really carved out your own theories in contravention to a lot of consensus. And that's something we really value and respect here at Punk Rock Traders. Now, I'll give you one final parting question. And it's a doozy, but I've heard economists like Claudius Somm advocate some different ways to fight inflation outside of the blunt tool of monetary policy. Are there any tools that you would advocate outside of monetary policy to fight inflation?
Oh, absolutely. Let's go back to a second. One of the things I say about monetary policy is it's not good against many of the forms of inflation that we face. For example, supply side inflation and or energy price inflation. Monetary policy is particularly ineffective against them.
Right.
So the answer is those are fiscal policy. And that's what I've been saying.
Right.
If you look at energy prices, okay, back in the most recent bout of inflation, they went up. The way we combated it was fiscal policy by hitting the strategic petroleum reserve.
Right.
To release petroleum. Okay. Well, there's a lot to be said for having strategic reserves of certain things that might be needed, like oil, so as to control inflation. There's a lot to be said for then giving the oil companies incentives to drill more, so we have more oil. So in the long run, we don't have oil inflation, price inflation again. So
right.
I'm going to tell you there's a lot of different tools in the fiscal tool basket for addressing inflation.
So you'd envision a strategic petroleum reserve for other crucial commodities or goods that inflation affects?
Yeah.
Absolutely.
It's part of also the whole thing about, to me, I'm a big person, as you've read on my site. We spent the last 40 plus years outsourcing the arsenal of democracy.
Right. That's why, yep. And we're completely incapable of fighting the type of conflict that the world now faces.
Correct. And we need to bring back the arsenal of democracy.
Right.
And in bringing that back, we're going to have some industries come back that are actually useful for combating inflation.
Right.
Okay. So I got a whole lot of fiscal things I would do. Some of them the Trump administration, I think, is going to stumble upon and do. I'm hoping. But
I'm hopeful too, Dr. Phil.
the last one I'm going to leave you with this one thought is the one thing the Trump administration is unlikely to do, but needs to do, is they need to actually put in more automatic stabilizer program. Okay. Claudia has her rule that says if unemployment jumps up in a certain period of time, we need to start doing that.
Right.
I agree with her in terms of, when I say doing things, we need to spend more money.
Right. Many people don't realize that that's the entire advent of the Psalm rule.
Okay. Well, so there you go. But I would suggest to you that we need more automatic stabilizers. The one thing that has become apparent to everybody by 2009 was nothing that the Bush administration did or that Obama did when he first came into office actually stopped the great financial crisis from being worse for the economy. It was the automatic stabilizers that kicked in. When people lost their jobs, they got unemployment insurance. You had Social Security rolling along with Medicare. It is these types of programs that actually prevented another Great Depression.
Right.
As opposed to bailing out the banks. That did nothing for preventing the crisis.
I agree. It did enrich a certain class of people.
Right.
For sure.
And unfortunately, as we have been enriching a certain class of people, it's actually been really bad for society.
Yes, I think also when I was looking at inflation over the last year, observing it quite closely, both professionally and personally, one of the things I noticed is that a lot of the sticky components in inflation seem to actually be from consumption of the ultra wealthy. In other words, where they used to get tapped out in certain consumption areas, like say dining out or travel, they now have such interminable resources that they can keep constantly consuming here. And that was one of the things keeping inflation higher for longer.
Yeah. But again, I would make the argument that said the wealthy have always been able to spend.
Right.
That's why they're wealthy. Okay.
Yeah. Yes.
They didn't have a constraint like you and I might have. See, I figured you were going to tell me that what you just discovered is how expensive having a child is. Okay.
I certainly have discovered that.
The moment of expense, when you go out to buy a diaper, and ooh, this will last, a week. And you're back out there 3 days later. Whoa, wait a minute.
I've had that experience very recently.
Exactly. The diaper budget was not what you anticipated.
Right.
And the last thing we should talk about is we have a demographic problem in the U.S. Even though people who make money are reluctant to have additional children. And that's really too bad.
It is.
Because they perceive it as too expensive. On the one side, having children has always been expensive. But you shouldn't think of a child as an expense. A child is much more than what they do to your bank account for the next 18, 20, 22 years.
Right.
Okay? We talk about all the illegal immigrants. I happen to think it's wonderful that all those illegal immigrants want to come to the U.S. to work. They think of us still as the land of opportunity.
Good one.
For most of them, I would say we need to be offering them a pathway to citizenship. We've got the dreamers who always should have had a pathway to citizenship. I agree with the Trump administration that the ones who have a prison record, a crime record, we should gently escort back out of the country. But if that's 100,000 people out of 10 million that just showed up, that means we got 9.9 million people. We should have a policy for them to stay permanently.
I agree. I agree wholeheartedly with that. And I think that honestly, it also bears out with the mandate that Trump got, because a lot of people seem to be voting against higher prices, and with a declining naturalized workforce or, naturally born workforce, we're simply not. One of the ways you can look at illegal immigrants, and I don't mean to be demeaning or crass, is that they're an army of people keeping prices down.
Sure.
And so removing that army of people keeping pricing down is only going to have one effect, which is to raise prices in this country. So I think from an inflationary standpoint, I agree with you that I hope that the deportation is very targeted and gives a path of citizenship to most of the people that are here.
Well, we need to solve that issue. I mean, we really do. Rather than play political football with it, let's solve it.
Right.
I mean,
Absolutely.
I mean, to me, illegal immigrants are sitting there on our meat slaughtering houses. I happen to like steak.
I do too. Yeah.
Well,
I happen to like the current prices.
Stop.
Yeah. We don't want more expensive steak, but that's one thing all Americans can get behind.
There you go. All right.
Hey, Dr. Field, it's been such a pleasure talking to you. I can't thank you enough, and I hope we get to do it again.
Very good. Looking forward to it.
Looking forward to it. Bye, Dr. Field.